Hello, my name is Justin Fromm, and this is going to be sensitivity analysis and risk incorporation in capital budgeting. First, we're going to cover some topics today. We're going to cover sensitivity analysis. What is it? Sensitivity analysis part 1 and part 2. One will focus on quantitative tools and the other will focus on qualitative tools. Then we'll move into how can we incorporate risk in capital budgeting, and then I have a reference slide at the end. So sensitivity analysis, why would we use a sensitivity analysis and why is it pertinent to our financial goals? The firm's main goal is to evaluate investment proposals based on the expected returns and risk and determine the feasibility. Sensitivity analysis is our way of determining the what-if situations. Overall, we want to determine how certain factors will affect a company's finances and identify if the risk and uncertainty is worth it. It also adds credibility to the financial model by testing the model across a wide set of possibilities. It adds flexibility within set boundaries when testing the sensitivity of dependent or independent variables, and overall, it enhances the company's decision-making abilities. I'm going to go quickly through some of the quantitative tools that we can use. I've got my main headers up here, and I'll be reading from some of my notes. The first one is understanding influencing factors. So here we're looking at defining key variables that will influence variation in the analysis. These will include adjustments to cost estimates, sales volume, interest rates, or even inflation rates. Value ranges. This is where we determine minimum and maximum values we will place on each variable. We will keep these ranges plausible to the scenario given. Creation of the scenarios. Adjusting variables one at a time while the others remain constant is a good way to ascertain which variables changes work the best. Model adjustments. Determining which financial models we can utilize to enhance scenarios. These can include IRR, internal rate of return, NPV, net present value, and profitability measures. Results and decision making. Analyzing results, comparing scenarios, and determining what risk and trade-off the company is willing to accept based on the strategic objectives. Now we're going to move into some qualitative tools. So this is the quality portion. Qualitative tools, expert assessments. When missing historical data, having experience from an expert provides valuable input when assessing different factors and their impacts. Additional scenario info. Outside of quantitative changes, it's important to identify reasons behind each scenario choice, which gives context to and clarity to decision makers and people that hold stake in the company. Risk identification. Identify key risks that could impact the project or decision. We can look at market conditions, key regulatory changes, etc. Additional range to sensitivity. Alongside quantitative measures, we can discuss adding extreme value ranges which might impact scenarios. This could be instances where we have another COVID scenario. External and non-financial impacts, assessing factors like regulation, technological advancements, environment, social, geopolitical, or even reputation considerations. We can look at recent situations such as the Bud Light controversy as an example. Now we're going to move into risk and capital budgeting. Capital budgeting is in place to determine which projects will yield the best return and enhance shareholder value and profit. The most common methods to capital budgeting is your discount cash flow or your NPV. This calculates present value of all future cash flow associated with a project and includes both initial investment and future cash in and outflows. IRR, which I mentioned earlier, internal rate of return, represents the project's rate of return in which the project is deemed acceptable if the IRR exceeds the rate of return. Payback period, time required for a project to recoup its initial investment. ARR, accounting rate of return, average accounting profit generated by a project at a percentage of the average investment used to compare multiple investment opportunities. Now let's look at some of the way that we can introduce any of these risks into our capital budgeting scenario. As we've talked about before, using a sensitivity analysis, we can adjust key variables in the model and determine how these changes would affect metrics such as NPV and IRR. We would assess the project's sensitivity to certain risk factors and decide on whether a project model is viable. We could also use scenario analysis to identify risk. Just like the scenarios we could use in the sensitivity analysis, we could make projections based on plausible scenarios that could actually play out. I.e., like I mentioned earlier, we could have another COVID situation, so we can kind of determine what risk we're willing to take if something like that happens again. Risk-adjusted discounted rate. Using this method, we analyze projects for profitability, and with projects with greater risk, we can use a higher discount rate. These projects with higher risk will have a higher RADR, and this means the rate of return must be higher to compensate for the increased uncertainty. I don't have much time left, so I'd like to give some examples of these and how we can use risk just very briefly. If we were to use a scenario considering financial projections and we were looking at how this would affect a company's NPV, we can look at something like unit sales volume. The first variable they could analyze is unit sales volume. So if the actual sales volume turns out to be lower or higher than projected, how would this impact NPV? Another scenario we can talk about when we look at capital budget for high risk ventures is take into account if suppose a company is evaluating two investment opportunities. One may involve expanding into a stable and mature market, while the other involves entering a volatile and high risk market. To determine the viability of each project, the company might lower risk adjusted discount rate to stable market project and a higher adjusted discount rate to the high risk venture. This ensures that the NPV analysis takes into account the varying levels of risk associated with each opportunity. That concludes my presentation. I went over a little bit on time, but I just wanted to make sure that I hit everything. So thank you.